This $3 ETF quietly crushes 90% of investors. ETF well-kept wealth secret. Have you ever felt the relentless pressure of trying to outsmart the market? The dizzying chase after the next big stock, the gnawing anxiety during a market dip? What if I told you there's a simpler path, a quiet powerhouse of an investment strategy that has consistently outperformed most individual investors for decades, requiring almost zero effort and offering true peace of mind? This isn't a secret held by Wall Street gurus, nor is it some complicated hyphy scheme. It's an ETF that already exists, yet most people overlook its profound power. Today, we're going to pull back the curtain on this unsung hero, the Vanguard Total Stock Market ETF, widely known as VTI, and uncover why it might just be the most intelligent long-term investment you'll ever make. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. The unseen battle. Why most investors lose. Let's start with a hard truth, backed by data. According to rigorous studies from Morningstar and S&P's own SPIVA report, the average retail investor dramatically underperforms the market. Think about this. Over the past 30 years, the legendary S&P 500 has delivered over 10% annually. The average investor? A mere 6% per year. That's a staggering gap. Learning point 1, the emotional trap. Why such a disconnect? It boils down to human nature. We're wired for emotion, not for the cold, calculated discipline long-term wealth-building demands. When the market plummets, a real fear that grips us all, we panic sell, locking in losses. When a new hot stock explodes onto the scene, driven by social media frenzy, we chase hot stocks, buying high, often just before the inevitable correction. This emotional roller coaster of buying high and selling low is a direct route to investment losses. But what if you could sidestep that emotional trap entirely? What if your investment portfolio wasn't swayed by headlines or fleeting trends? VTI, your bet on the entire U.S. economy. So, what exactly is VTI? Many are familiar with the S&P 500, which comprises 500 of the largest U.S. companies, the titans of industry. But VTI goes even broader, wider, deeper. It tracks the entire U.S. stock market. We're talking over 4,000 companies, from the tech giants like Apple and Microsoft, right down to the nimble small-cap growth stocks you've likely never heard of. Learning point 2, unparalleled diversification. Instead of trying to pick the needle in the haystack, VTI simply buys the whole haystack. You're not betting exclusively on technology, or energy, or financial services. You're placing your bet on the collective innovation, resilience, and growth of the entire U.S. economy. It's the ultimate broad market exposure, significantly reducing single stock risk and creating a truly robust, diversified portfolio. Imagine holding a tiny piece of almost every publicly traded company in America. That's the powerful, yet beautifully simple, reality of owning VTI. The numbers don't lie. VTI's consistent performance. Let's talk returns. Because ultimately, that's what fuels financial independence. Over the past decade, VTI has delivered an average annual return of over 11.6%. If you had invested, say, $10,000 just 10 years ago and simply let it sit untouched, unmanaged, without a single worried glance, you'd be sitting on roughly $30,000 today. That's the magic of compounding returns at work, quietly and consistently. Learning point 3, passive outperforms active. Now, compare that to the vast landscape of actively managed mutual funds. These funds often come with hefty investment fees, and despite the promises of expert managers, they consistently struggle to beat the market. S&P's SPIVA report for 2024 revealed that a staggering 65% of active large-cap U.S. equity funds underperformed the S&P 500. Over a 15-year period, there were no categories in which a majority of active managers outperformed. So, when we say VTI beats 90% of investors, it's not hyperbole, it's a reality proven by consistent data. The sheer simplicity of VTI is its secret weapon. One ticker, one fund, one decision. This beautiful simplicity helps you bypass the emotional landmines that derail most investors. The pandemic test, VTI's resilience. Think back to March 2020. The world was gripped by uncertainty. Markets plunged over 30% in a matter of weeks. Panic was a palpable force, compelling countless investors to sell their holdings, abandoning their financial goals. But what about VTI holders? Many simply held on. Why? Because their investment strategy wasn't tied to the fate of a single company, but to the entire economic engine of a nation. And what happened? By the close of 2020, the market had not only recovered, but VTI finished the year up over 20%. It's not magic. It's the power of long-term exposure to the market and a mindset that says, I'm in this for the long haul. This is about resilient investing. The fee factor, keeping more of your money. Now, let's talk about the silent killer of wealth, fees. If you're paying 1% or more in management fees for an active mutual fund or a specialized strategy, you're essentially handing over a significant chunk of your future returns. VTI's expense ratio is a minuscule 0.03%. That means for every $10,000 you invest, you're paying just $3 per year in fees. To put that into stark perspective, the average actively managed equity mutual fund fee in 2024 was around 0.4%, down significantly from 1% decades ago, but still much higher than VTI. On a $100,000 portfolio, that's $400 a year. With VTI, it's just $30. Learning point 4, the compounding power of low fees. This difference, seemingly small, magnifies exponentially over time. Imagine two investors, both start with $10,000, both earning a hypothetical 10% annual return before fees. One chooses VTI at 0.03% expense, the other an active fund at 0.4%. After 30 years, the VTI investor would end up with approximately $174,000, while the mutual fund investor would have closer to $139,000. That's a difference of over $35,000 purely due to fees. This is why ultra-low-cost ETFs are essential for maximizing long-term wealth. The secret weapon, dollar-cost averaging. I know what some of you might be thinking. Isn't this boring? And yes, perhaps it is. But here's a secret that truly wealthy understand. Boring builds wealth. The best investment vehicles are often the ones you can set, forget, and let time work its magic. Excitement in investing often comes at a cost. Think the allure of crypto investing, penny stocks, or meme stocks. These can offer dazzling short-term gains, but they carry astronomical investment risk and often lead to significant losses for the average person. VTI isn't designed for overnight riches, but it's designed for sustained wealth creation. It's the tortoise in the race, and we all know how that story ends. Learning point 5. Discipline trumps timing. What if you supercharged VTI's power with consistent, disciplined investing? Imagine committing to dollar-cost averaging, investing a fixed amount, say $500, every single month, regardless of market highs or lows. Over 20 years, that's $120,000 of your own money invested. But assuming a conservative 8% annual return, you'd end up with over $275,000. Historically, VTI has delivered even better. This is how people quietly build six-figure portfolios and even seven-figure portfolios, while others are still chasing the next fleeting hype. This is the essence of strategic investing. VTI versus the rest, a quick comparison. Some of you might ask, should I just go all in on VTI? The answer is maybe. It depends on your unique financial goals and risk tolerance. VTI offers ultimate simplicity, broad market exposure, ultra-low fees, and historically strong returns. But other ETFs serve different purposes. VTI versus SCHD, Schwab US Dividend Equity ETF. SCHD is fantastic for income investing, yielding around 3.5% and focusing on quality dividend stocks. But it covers only about 100 large-cap companies, missing the growth potential of mid and small caps. VTI, with its 4,000+ companies, offers a much wider net. VTI versus VO, Vanguard S&P 500 ETF. VO is also an excellent fund, tracking the 500 largest U.S. companies. However, VTI, by including mid and small cap companies, offers even broader diversification. In fact, between 2001 and 2023, VTI slightly outperformed VO by capturing the growth surges in smaller companies. So, unless you have a very specific reason to prioritize dividend income or solely large-cap exposure, VTI may just be the one ETF to rule them all for your core investment portfolio. Your path to lasting wealth, simplicity and patience. The path to building wealth doesn't have to be a complicated maze. You don't need a dozen different ETFs, nor do you need a PhD in finance. Sometimes, all it takes is one strategically chosen index fund, a resolute commitment to consistent investing, and the unwavering patience to let time work its profound magic. That's the powerful, yet unassuming, offer of VTI. If you're tired of chasing fleeting returns, if you're ready to finally embrace a smarter, more sustainable approach to wealth creation, this investment vehicle might just be the one that fundamentally changes your financial future. If this deep dive into VTI has illuminated a new path for your investment strategy or simply reinforced the wisdom of long-term wealth building, we encourage you to like this video, share it with anyone who needs to hear this message, and most importantly, subscribe to our channel for more insights into truly smart investing. And please, we'd love to hear your thoughts and questions. Leave a comment below. Your engagement helps us continue to deliver valuable, actionable financial education. Final important disclaimer. Investing in ETFs involves risk, including the possible loss of principal. The value of your investment will fluctuate. The information provided in this video is for educational and informational purposes only and does not constitute financial advice. It is essential to conduct your own research and consult with a qualified, independent financial advisor or fiduciary financial planner who can assess your personal financial situation, risk tolerance, and financial goals before making any investment decisions. Past performance is not indicative of future results.